There is a company in stock market worth around 20 billion. Its expected full year revenue less than 300 million. That is not valuation, that is the garbage math wearing a suit. Another company is worth more than 60 billion while still losing money, and Tesla is worth around 1.5 trillion even though its 2025 net income was less than 4 billion. So today I'm asking a one simple question. Are investors buying businesses? Are they buying expensive fairy tales with stock tickers? Because Wall Street has turned valuation into a magic trick. Take a company, add words like AI, quantum, space, robotaxis, or disruption, throw in a clean investor deck, a hockey stick chart, and a joint total addressable market. Then suddenly, tiny profits start walking around with billion-dollar confidence. Today, I'm not here to worship market cap. I'm here to expose how dumb these valuations actually are. In 2025, Tesla reported about 94.8 billion in revenue and about 3.8 billion in net income. Yes, Tesla is a real company with real sales and real profit, but that actually makes the valuation harder to justify because a company earning less than 4 billion a year is being valued at roughly 1.5 trillion. That valuation is not being carried by today's car business. It is being carried by tomorrow's promises like robotaxis, artificial intelligence, energy storage, humanoid robots, and whatever futuristic label gets added next. Tesla is not being priced as one company, it is being priced as a car company, an AI, a robotics, an energy, and a taxi company, all at once. Maybe some of that become real one day, but investors are already paying as if that the whole story has already happened. That is not a disciplined valuation, that is the financial fan fiction. And this is where the risk becomes brutal. When a stock is priced for perfection, good results are not enough. The company has to deliver perfectly, repeatedly, and loudly enough to justify a valuation that already assumes multiple future businesses will show up, scale, dominate, and print money. That is not a normal hurdle. That is the valuation gymnastic. If even one part of the story disappoints, that beautiful trillion-dollar narrative can start looking like a very expensive hallucination. And this is the problem. If a company already has revenue and profit, but the valuations still need multiple future miracles to make sense, imagine how dangerous it becomes when the company has smaller revenue, no real profit, and the market still gives it a gigantic price tag. That is where valuation nonsense gets even worse. That brings me to the Rocket Lab. Rocket Lab has the perfect hype recipe. Space launches, satellite, defense, national security, and infrastructure beyond Earth. Put dramatic music behind it and suddenly everyone feels like they are investing in a future of civilization. But then income statement walks in and ruins the party. Rocket Lab is worth around $61 billion. Its PE ratio is negative, which means the company is not profitable on net earning basis. In Q1 2026, Rocket Lab reported about $200 million in revenue and more than $2.2 billion worth of signed future contracts. Sounds impressive until you see the loss. $45 million in the same quarter. So let's keep this simple. Rocket Lab is a $61 billion company that is still losing money. That is the problem. The market is not paying for profit, it is paying for the hope that one day Rocket Lab becomes big enough, efficient enough, and profitable enough to justify today's price. That is not valuation discipline. That is a loss-making business wearing a space helmet and charging investor VIP pricing. Space may become huge, Rocket Lab may become important, but a real future does not automatically make today's stock price rational. Space can be massive and shareholders can still overpay. Now let's go to the cleanest example, IonQ. Quantum computing is the kind of phrase Wall Street loves because almost nobody fully understands it. But everyone knows that it sounds expensive. Say quantum in an investor meeting, and suddenly normal financial rules start packing their bags. IonQ is worth around $20 billion. During the first quarter of 2026, IonQ reported about $64.7 million in revenue. For the full year of 2026, the company expected revenue of about $260 to $270 million. So let me make this simple. A company expected to produce less than $300 million in annual revenue is trading around $20 billion market value. That is the financial financial cartoon. That is the valuation equivalent of putting a crown on baby because one day it might become king. And there is another detail. IonQ also reaffirmed full year adjusted EBITDA loss guidance of roughly $310 to $330 million. So the operating business is still expected to lose money on that adjusted EBITDA basis. Could quantum computing become revolutionary? Absolutely. Could IonQ becomes one of the winner? Maybe. But maybe is doing a lot of heavy lifting here. For today's price to make sense, the technology has to scale. Customers have to adopt it. Revenue has to explode. Margins have to appear. Competitors have to be beaten, and future capital raises cannot punish existing shareholders too badly. That is not one assumption. That is the whole staircase of assumptions. And if one step breaks, the valuation does not gently walk down, it falls. This is the miracle premium. The company does not need to succeed. It needs to succeed so aggressively that today's extreme valuation eventually looks reasonable. That is not investing in a business. That is paying upfront for a miracle and hoping that the receipt makes sense later. This is where investors confuse three very different things: a big market, a real company, a good investment. Those are not the same thing. Electric vehicles can be huge, but not every electric vehicle stock will win. Space can be huge, but not every space company will make money. Quantum computing can change the world, but that does not mean that every quantum stock deserves a $20 billion valuation today. A big company is not a blank check. A visionary founder is not free cash flow. A beautiful product is not a durable margin. And a total addressable market is not money in shareholders' pocket. This is a big market delusion. Investors see a giant future market and start pricing companies as if victory is guaranteed. But business does not care about your PowerPoint. Competition shows up, costs rise, margins shrink, customers move slowly, technology takes longer than promised, capital gets expensive, and suddenly that beautiful valuation model starts looking like Excel fan fiction. The best warning label is WeWork. At one point, WeWork was valued at $47 billion. The company was dressed up like tech platform. The founders was treated like a genius. The branding was everywhere. The pitch sounded revolutionary. But underneath the fancy language, community vibes, and Silicon Valley costume, WeWork was largely a real estate business with broken economics. Then reality walked into the room. The IPO collapsed. The valuation fell apart. The company went through bankruptcy. After bankruptcy, its estimated value was about $750 million, from $47 billion to $750 million. That is not correction, that is exorcism. That is what happened when a garbage valuation finally meets a real income statement. And the scary part is this: before it collapsed, the valuation looked real. Smart investors backed it, media repeated it, bankers marketed it, founders celebrated it. Everyone acted like the number was truth until the business model exposed the costume. That is why market cap should never be worshipped. A high valuation becomes garbage when profits are weak, cash flow is missing, margins are theoretical, losses are heavy, and the investment case depends on almost everything going right. That is when investors need to stop clapping and start calculating, because every company eventually faces the same test. Not the vision, not the market size slide with a $1 trillion number in giant font, hoping nobody asks where the profit is. Can this company generate earnings? Can it produce cash flow? Can it defend margins? Can it earn a return on capital? That is what separates a business from a dream. So when you hear that a company is worth 20 billion, 60 billion, or $1.5 trillion, do not stop at the headline number. Ask what has to happen for that valuation to make sense. If it depends on strong profit, real cash flow, durable margins, and disciplined growth, then the valuation has a foundation. But if it depends on perfect execution, unproven technology, endless patience, massive adoption, and profits that have not arrived yet, call it what it is. That is not valuation discipline. That is garbage math with better branding. That is how overpriced stocks survive. Losses become temporary, tiny revenue becomes early potential, missing profits become long-term vision. Investors pay today for money the company may never earn, but eventually The market stops buying the story and start reading the numbers. Then it asks one brutal question: where is the money? If the answer is still coming soon, that $1 billion valuation was never proof of value. It was hope with a ticker symbol. The stock market can price a dream, but it cannot protect garbage math from reality forever. If you want to understand how a Middle East war could weaken the US dollar and shake the old petrodollar system, watch this video next. And if you want to know how a closure of Strait of Hormuz could hit your grocery bill, watch this one next. If you want simple, honest conversations about money, investing, and hidden forces behind your cost of living, like and subscribe. I will see you in the next one.